Um, what is a health savings account? Most of you have an account open already, so you know what it is. It really is truly just that. It's a savings account for qualified medical expenses and to help you save and prepare for those health expenses once you do incur those. Who's eligible for a health savings account? A couple criteria. You must be covered by a high deductible health plan. Not covered by any other insurance. So if you are on your high deductible health plan and you're also covered on a spouse's plan that is not high deductible, that makes you ineligible to contribute to an HSA. So you can't be covered by any other. That would also include Medicare and TRICARE. And then you can't be claimed as a dependent on someone else's tax return. And that comes into play when we look at some of your dependents. Health savings accounts are really based on the IRS regulations and rules. And so they're not always compatible as to how you would think. So not long ago, they had extended coverage for your dependents up to age 26 for your health insurance. However, the IRS did not follow suit and say that you also had that from an HSA standpoint. So you may have someone who's 25 years old and is on your health account, on your health plan, but they're working full-time. You no longer claim them as a tax dependent, so you cannot use your health savings dollars to pay for that person's medical expenses because you can't claim them as a tax dependent. So it's not the most intuitive, and again, health savings accounts follow the IRS guidelines, not necessarily health plan guidelines. So there's some benefits to that in the end, but I know there's a lot of confusion around that. So they may be on your health plan, but if you can't claim them as a tax dependent, you can't use your HSA dollars to pay their expenses. Interestingly enough, they can have their own HSA account, which you could help them fund, but you can't use your HSA dollars. So just a point of clarification there. Reasons why an HSA may be right for you. It helps you invest. Oh yeah, question.
Going back a step, you said you could fund a different HSA account or another person's HSA account. Does that have to be post-tax dollars?
Yeah, they are the only ones that could claim pre-tax, the person whose account it is.
Can you fund, I know it sounds stupid, but can you make deposits post-tax?
Yes.
To your own?
Yes.
How do you do that?
Yep. So good question. So at the end of the year, you have not maximized, you've not hit your maximum contribution. So you do pre-tax dollars, maybe you do a set amount, but at the end of the year you realize, or you actually have until tax day of the following year to make the previous year's contribution. So tax day of 2019 is the last day you could make a 2018 HSA contribution. So if you determine that you're getting a tax refund or you've got a bonus or something, you want to put additional dollars into your health savings account, you didn't do it pre-tax through your payroll, you can contribute to your health savings account. So you make a deposit into your health savings account, you complete a contribution form, and then you claim it on your taxes. There's a line item on your taxes for HSA contributions.
So there's no difference between pre and post-tax dollars related to the maximum contribution?
Correct. You know, a little bit. I mean, I think if you can do it pre-tax, you get that immediate relief from not having taxes withheld on your payroll. And if you do it post-tax, you get to claim that as a line item on your taxes.
But the cap's the cap.
The cap is the cap. Yep. So $3,500 for individual coverage. For single coverage, $7,000 for family. If you're age 55 and over, each year you can do an additional $1,000. But that's it. You can't exceed from a contribution standpoint.
How old and older?
55. 55 and over.
But if you're just taking the standard deduction, then itemizing that line item.
Right. Would not help you if you took the standard. Yeah. Exactly. Yeah.
Can you explain that last line? Cannot be claimed as dependent on someone else's. What is that?
Right. So that was a situation where you have a dependent who, again, you have a 25-year-old who's on your health plan. because the federal law allows you to have that person on your health plan, but they're working full-time and they're not a tax dependent of yours. So you could not, like you can't, that person can't be claimed on your tax return.
But if they have medical expenses, you can use your HSA to pay for their medical expenses, or you cannot?
Not if they're not a tax dependent.
What if there's a divorce situation, one child goes with mom, one child goes with father?
Yeah.
The medical expenses for the child that's not with you, you can't make.
You can, and there's an IRS rule for divorced parents that says regardless of what your divorce decree says as to who gets them as the tax dependent, sometimes it alternates, or you get two, your spouse gets two, your ex-spouse gets two, however your divorce decree lays that out. The IRS guideline is it doesn't matter what your divorce decree says or who claims them as a tax dependent, both parents can use HSA dollars to pay expenses of the children. As long as they're of a certain age, again, and they're a tax dependent. But it doesn't have to be your tax dependent. It could be, that's the only situation where it varies. So for divorced families, both parents can use HSA dollars to pay for the children's expenses. All right. Love the questions. I love when it's interactive. So again, lots of reasons why you would want to have an HSA. Again, health savings account, you can contribute. It's not like an FSA. You don't lose it at the end of the year. So it continues to roll over. You keep your remaining funds. Again, you don't use it or lose it like the FSAs. Your HSA is portable. Your HSA account is your HSA account. It's not your employer's, it's yours. So it stays with you through retirement. So if you have a career change, you have a difference in coverage for your health plan, your health savings account always remains your health savings account. It's a great enhancement to your retirement. Again, there are tax advantages to having a health savings account. It's pre-tax dollars that you can put in, and it continues to grow tax-free, and it will come out tax-free as long as it's used for qualified medical expenses. There's no other investment vehicle out there that has triple tax advantages. So IRAs and your 401k, you get some of that deferment, but at some point you have to pay taxes on that. It comes out as ordinary income. Not so with HSAs, as long as it's used for qualified medical expenses. There's no time limit on when you have to spend your HSA dollars. You could incur an expense today and pay for it out of pocket, save your receipt, and a year from now, 10 years from now, into retirement, take that money out of your HSA to reimburse yourself. You don't have to reimburse yourself in the year you incur the expense. So that's important as you look at that as an enhancement for retirement planning. It's also a great budgeting tool. I spoke to a woman that uses that approach from a budgeting standpoint. So throughout the year, she has 3 children. She's definitely a spender of her HSA dollars. And she tries to pay as much as she can out of pocket. At the end of the year in December, she requests that we send her a check for all of her qualified medical expenses. She kept all of her receipts. She sends us an amount and says, I want to be reimbursed for all of my medical expenses. We send her a check in December, and she uses it for her holiday shopping. So that's how she manages her family budget. She pays as much as she can out of pocket throughout the year, saves her receipts, and says, this is what I've paid throughout the year. Send me a check, and she budgets that way. She wouldn't have to request it in December. She could request it again the next year, the following year, 5 years, 10 years, whatever it is. But the important thing is save your receipts, and you can reimburse yourself at any time for money you've spent out of pocket. A good thing to remember with that too. So if you're just starting out your health savings account and maybe you only have a few $100s in there and you incur an expense that maybe is a couple $1,000s or over $1,000 depending on what your deductible is, you don't have the money in there right now to cover that expense fully. So you can spend your HSA dollars, what you have, to cover as much as you can, and then whatever you pay out of pocket for the difference, as more money goes into your health savings account, you can request that to be reimbursed for you. So again, as long as you have your HSA set up, when you incur the expense, you can withdraw that money for anything you've paid out of pocket at any time. So a good thing to remember if you incur those expenses early before you have substantial dollars in your HSA. Does that make sense?
You mentioned 10 years. Is that a number or is it?
There is no limit on when you can pull the money out for your HSAs. So, and again, I mentioned that mobile app. Most individuals have a smartphone these days, you can take a picture of the receipt and it uploads into your health savings account. So it's a good way to track your receipts, and I'll show you how we help you track that. But if you have the mobile app, it's very, very simple to download. I'll show you how. But that will help you keep track of your expenses. Take a picture of it. We all know paper fades. If you've ever had old receipts and you pull them out, sometimes they're hard to read. Take a picture of it as soon as you incur that expense. I also talked to a woman the other day who didn't save her expense. She was shopping at her receipt. She was shopping at Walmart, threw everything away, and then ended up digging through the garbage trying to find her receipt. Take a picture of it right away. You've got your phone with you, and then you don't have to worry about where you put it, or saving it in a shoebox.
Now, in retirement, you said it's a one-time rollover in an IRA, that you couldn't take, if you had a pension or a deferred comp, you couldn't take yearly, could you take
No.
$100 tax-free and put it in there?
Nope, it has to be an IRA. And again, that's an IRS rule. So you could take, again, you can't contribute more if you've got family coverage more than $7,000 a year. Say out of your payroll, you contribute $2,000. You still have $5,000 left that you could contribute. You could take that out of an IRA. You have once in a lifetime rollover from an IRA into your HSA. So up to the max, right? So, right. So if you didn't do anything pre-tax, you could do $7,000 once. Yeah. So January 1, if you wanted to, you could for the year, and you'd put $7,000 in there.
Couldn't do it the next year.
No, once in your lifetime you get to do that. So a couple reasons why you would want to do that. Again, when it comes out of your IRA, it is taxable. When it comes out of your HSA, it is not. And you sometimes have a hardship where you have a large medical expense and you don't have the funds. So rather than taking a loan against your 401k, if you've got an IRA, you can take the money out and put it into your HSA and you've got funds available for that. Again, otherwise, if you want to do it early and let it grow tax-free and come out tax-free, you could transfer that into your HSA. Good questions. So an example of post-tax and pre-tax, even if you know you're going to spend every penny that you put into your HSA, again, people are at different phases in their life in terms of medical expenses. So even if you know you're going to spend it, run it through your HSA. You get that pre-tax advantage. So post-tax, if you earn $100, you take that $100, put it in your pocket. You're only putting $75 in your pocket because taxes are withheld from that. If you put it in pre-tax, you've got that $100 earnings, you put it into your HSA, zero taxes, you have $100 to spend toward medical expenses versus $75. So if you get a medical bill for $100, you have $100 in your HSA to pay for it versus the $75 in your pocket. Imagine if that medical bill was now $1,000. You'd have $1,000 in your HSA versus $750 in your pocket. I'd rather have the $1,000 to pay the HSA or the medical expense than the $750. Even if you know you're going to spend it, put it into your HSA. It will grow. You'll have interest in there until you spend it. But the pre-tax really does add up for you. And again, you have access to those funds immediately. Make sense? Here are the annual limits that we talked about. So again, single coverage, this is based on your medical plan coverage. So if you have single coverage, you can contribute $3,500. If you have family coverage, and the IRS determines that as you and a spouse, you and a child, so it could be employee plus child, it could be employee, spouse, children. As long as it's more than single, it's considered family. And then again, the catch-up contribution is $1,000. One thing to note on that $1,000, HSA accounts cannot be joint. They can only be in one person's name. You would want to have your spouse or have their own HSA for the catch-up contribution. So if both you and your spouse are over age 55, you put $1,000 into your HSA, your spouse cannot put $1,000 into your HSA. They have to put their $1,000 into their HSA. So that's the only time that you're required to have separate accounts. Otherwise, you could have one account that you just contribute the family maximum to, and then the other person wouldn't contribute to theirs because you could use your dollars to cover both. But the only time that you're required to is that $1,000 catch-up. So they have to put their $1,000 into their HSA, you have to put your $1,000 into your HSA.
Can you do that with that rollover? So it can be 14,000 then?
Nope, you can't go over the family max of 7,000. Yeah, good idea though, but no. So what is reimbursable? Qualified medical expenses, I've got a few of them listed there. The IRS has a very, very long list. Again, the emphasis is on preventive. So what your insurance may not cover doesn't necessarily mean that your HSA dollars can't be used to cover it. A good example of this is LASIK surgery. LASIK surgery can be paid for from your HSA dollars. Typically, most insurance plans do not cover that. It's considered cosmetic by a lot of insurance plans, so they don't contribute or they don't cover it. But your HSA dollars can. It can save you. It's considered preventive from a vision standpoint, and you can use your HSA dollars for that. Yeah, question?
How does your debit card know what's covered and what's not?
Yeah, good question. Your HSA debit card, some of you may remember when we first issued the new debit cards, they were really locked down. We tried to help guide from that standpoint in terms of what was a qualified medical expense. So if you were at Walmart and you had a prescription and you had a bunch of other items, you would swipe your card, your HSA card, and it would only take the qualified medical expenses, and then you'd have to pay for the balance. So what happened was our chip and our technology within the card was a little bit ahead of its time. So merchants didn't always keep up with the codes the way that they should, and sometimes it depended with some of the smaller pharmacies. There's an international code for qualified medical expenses, and I'll spare you the details on that. But so the card was looking for that, and so it would decline if it wasn't for a qualified medical expense. So what we ended up doing, though, was loosening up some of those restrictions because some of the smaller pharmacies, again, depending on if you checked out at the pharmacy or you did the regular cash register, sometimes they had the right codes in and some didn't. So we were a little bit ahead of our time from a technology standpoint. But there are merchant codes in there. So pharmacies are recognized, the CVS, the Walgreens, the type of places you would normally spend money for qualified medical expenses, those are all approved merchants. So it will be up to you to separate, though. If you buy a greeting card along with your prescription and you buy soda, you'd have to separate those out. But it will be approved at those. It will not be approved at a gas station, an auto repair store, liquor store, casino, any of those places. It will automatically decline because they don't carry qualified medical expenses.
Saying now if you shop at a pharmacy, no matter what you get, it's going to go through?
Yes, yes.
I thought it was great, excuse me, when I was picking up a prescription one day at Shopko, and I was thinking to myself, our toothbrush part of it, is that covered or not? And to myself, I was like, probably is.
Yeah.
And I paid at the pharmacy, and she said, well, you owe us $3 or whatever because the toothbrush isn't covered.
Yeah.
I kind of like that.
It's a great feature, and like I said, we were a little bit ahead of our, from a technology standpoint. CVS recently went into Target, and Target did not update all of their registers. So if you checked out at CVS at the pharmacy, it would do that. But if you checked out at the Target register, they didn't update all of their codes. And so we were running into cards being declined when they should have been accepted. And so we opened it up a little bit, but it is by merchant. So if the place offers qualified medical expenses, it can be used there. If it doesn't, it will decline. So, good question. HSA distributions, as we've talked about, they're tax-free as long as it's for a qualified medical expense. You can spend the dollars on your spouse. And again, your spouse and dependents do not have to be on your high deductible health plan. Again, this comes into the divorced family situation. If your children are on your ex-spouse's medical plan, you can still use your HSA dollars to pay for your children's expenses. And again, as long as your spouse is covered by a high deductible health plan, they may be on their own plan, but maybe you choose to put all of the maximum $7,000 into your HSA. You can use your HSA dollars to pay for your spouse's expenses, even though they're not on your health plan. Yeah.
How do we know what is covered? You mentioned toothbrushes, but I've heard people buying razors with it, paying for massages. Like, what exactly is covered and what isn't? How do we know?
Yeah, the IRS website has the most comprehensive list, and I would have you look there. But again, the burden is really on preventive. So a massage, some of the other things that wouldn't be covered by your health insurance, a lot of holistic things are covered because it's preventive or it's treating an ailment, a disease. As long as you can make a case for it being preventive, at the end of the day, you're ultimately responsible. If it's not on the IRS list, but you can make a case for it being preventive or helping with a disease management or something along that line, if you ever get audited, the burden of proof would be on you that you're using it for that purpose. But the IRS list is pretty exhaustive, but you'll find some things on there that you wouldn't normally see, and massage is certainly one of those. Again, the IRS guidelines are much different than what your health plan guidelines are. HSA distributions, you can't use it to pay for your health insurance premiums. The only time that you can use it for insurance premiums is COBRA continuation, unemployment insurance while you're unemployed. Those receiving Medicare can no longer contribute to an HSA, but you can use your HSA dollars to pay for Medicare premiums, all of them except Medigap premiums. Long-term care insurance premium is something you can also use your HSA dollars for. Tax treatment of HSA distributions, again, as long as it's for a qualified medical expense, it comes out tax-free, the distribution. If it's a non-qualified medical expense, and you're 65 and over, it's just considered ordinary income. And so you're taxed on that as you would at your ordinary income tax rate. If you're under age 65 and you use it for non-medical, there's also a 20% penalty that you incur if you pull those HSA dollars out. And again, that doesn't apply if you're disabled or if you're eligible for Medicare. So we talked about the different ways to access your HSA account. Online, there's a lot of information online if you go online and, again, set up your username and password. That same username and password applies to your mobile app. There's also Touch ID, so you just put your thumbprint on and you can gain access to your mobile app, the mobile app that way. If you have any of your accounts at Associated Bank, you also have what we call single sign-on. So if you go into your Associated Bank application, it would have your checking account, your savings, your mortgage, and your HSA dollars listed all in one. Otherwise, debit card can be used for your expenses as well. So we'll go through each one of these here to talk about things that you can do within each one of those. So logging into your account, for those of you that haven't, you would go to associatedbank.com, and then there's an area that has a drop-down for online banking for consumers. You would select HSA, and then you would log in, again here, with your username and password. So this is what your homepage would look like if you looked at it online. You could view your contributions, distributions, investments. We'll talk about the others, authorized signers, beneficiaries, and bank account information in a minute. But all of these are available on the top where it says Dashboard, Accounts, Tools, and Support. So we'll talk about each one of those. So if we're looking at, again, the main page, and I had said if you take a picture of your receipts, you can also scan them and upload them. We'll keep track of what you've reimbursed yourself for and what you haven't. So if you want to upload your receipts and not reimburse yourself right away, we'll tell you which ones are eligible to be reimbursed, and we'll total that for you up here. So if you do have a major expense and you need to pull that money out, you know exactly how much you can pull out and still have it be tax-free because you've saved your receipts and you've spent it on qualified medical expenses. So we'll help you keep track of that if you upload your receipts. And again, we'll keep track of that into perpetuity as long as you have your account open. So into your retirement age, if you decide you don't want to reimburse yourself, you just want the funds to grow, you can always pull it out at any time in the future. And as long as it doesn't exceed the dollar amount that we're tracking for you, it's considered qualified medical. I also had a gentleman who told me that he's using it to save for college tuition. So the funds are growing tax-free while it's in there, and he's paying for his medical expenses out of pocket. When his child gets to college, he'll pull the money out because he's got his receipts and everything tracked in there, and there's no tax consequence. So again, it's a savings tool if you choose to use it that way. Just one other thing here too, it will help you track which expenses you've incurred, whether it's dental, whether it's vision, whether it's medical, whether it was you, whether it was your spouse, whether it was your dependent. You can kind of track where your expenses were if you choose to. If that's important to you, you can track it that way. So under tools and support, there are lots of things that are available to you on there. There's a lot of frequently asked questions. If you're looking for your tax forms, we'll send it to you in the mail, but if you've misplaced it or you're working on it, it's always available online. One of the things that, again, here is just kind of the statements and tax statements that are available. One of the things that I think is important is for you to make sure that you add your beneficiary online. So you may have completed beneficiary forms with your employer for other accounts, for your 401k, for whatever it is for your retirement account. Add your beneficiary on here. You can add, you can change, you can do whatever you'd like online as well as on the mobile app. From a tax standpoint, your spouse would receive the same tax benefit to your HSA. So if you were to pass, your spouse is typically the beneficiary. The tax status of your HSA account retains its tax status for your spouse. It doesn't for anyone else, only your spouse. So your HSA account becomes your spouse's HSA account as the beneficiary. It retains that tax status. Anyone else, though, it becomes part of your estate and taxable as part of your estate. Authorized signers, that's a great thing. Yeah.
So how does that work if your spouse has an HSA out there and say you pass and then that becomes his?
Yep. They can roll it over and combine it into one. So that's always an option. You can always combine your HSAs. Adding an authorized signer This is great. I have kids that are in college, and an authorized signer just means that they receive their own debit card. They don't have any other access to my account. Other than that, they get a debit card in their name. So if they have prescriptions they need to pick up while they're at school, they can use the debit card. We don't charge for additional cards. You can have as many authorized signers as you'd like. So you could have a card in your spouse's name. You could have it in your children's name, children over the age of 18. But it's great for college-age children. And you can do that all online, set up under your profile. You can add a dependent if you like. That just helps you track their expenses. You can also set up a bank account that you can tie to your HSA, and this is a great feature. If you forgot your debit card and you paid for something out of pocket, you can go online or use your mobile app and transfer the money from your HSA directly to your bank account. It does not have to be an Associated Bank account. It can be any checking or savings account at any financial institution. We'd love for it to be at Associated, but it doesn't have to be. And you can go again online and set that up. If you need help doing that, you can contact our customer care and they can walk you through it and say, here's where you'll find these numbers, and they'll help you set it up. But it's a great, great feature just, again, to be able to transfer money out of your HSA into your checking account. Or, again, at the end of the year, if you want to make a post-tax contribution, you can transfer money from that primary checking or savings account into your HSA and then claim that post-tax on your tax return. So different payment methods. Debit card is by far the most common way that people take distributions from their HSA. You can also request us to send a check if you would like. That's this direct deposit here that you'll see when you're setting it up. Again, most people do the debit card, but maybe you have a dentist or someone that doesn't accept debit cards or credit cards. You can go online and have us send them a check. The nice thing is, for those who have had children in braces and you pay that fee every single month while they're wearing their braces, I've had 4 that have done that. So you can set it up where we send a recurring check every month if you'd like, or however long you'd like to set it up. Or if you're on a payment plan for a major expense with a hospital or a clinic or a physician, you can request us to send a check every month, and we're happy to do that. So there's no cost for doing that either. So, and this is where we talk about having your account set up. Again, you can have the transaction between funds. So again, you have access to your debit card. You can schedule a check. Your debit card can also be used at an ATM. You can withdraw up to $300. It's actually $305. We have it set at $305 because sometimes Associated doesn't charge a withdrawal fee, but if you're out of state or you're at a network that we're not affiliated with, they may charge a fee. So we set it at $305 just in case you were at an ATM. But if you need access to cash immediately, or for whatever reason somebody's scanner is not working at a pharmacy or something, you can go to an ATM and take a cash withdrawal. Of course, my college children don't know that, so their debit card would work, but I'm not telling them that. You also have an option to invest your funds. So once you have $1,000 in your cash account, in your HSA account, anything over that you could choose to invest if you want to. Our minimum is $1,000. You can set that at any threshold that you would like. If your deductible is $2,500 and you'd feel more comfortable having $2,500 in your cash account, you could set it at $2,500. And I'll show you how to do that in a second here. So we have a number of mutual funds that you can choose for your investments. Associated Trust Company does oversight for that. So what we're looking for are the best performing funds at the lowest expense ratio. So when I show you the list of funds, you'll see like an R6 or you'll see an institutional share class. As part of our trust department, we have access to share classes that have a much lower expense ratio. And we're always looking for the lowest expense, the best performing funds. So I'll show you that in a second, but you'll be able to see the performance of the funds under the investment tab online. You can also see this on your mobile phone. So it's great to see it from a performance standpoint. You can always transfer money back and forth from the investments to your cash account and vice versa. You can set up, again, what we call automatic sweeps or automatic transfers. So anything over $1,000, if their contributions are coming in, it will automatically sweep into the investments you've chosen. If you spend down and it goes below 1,000, it'll automatically sweep back to put that back up to 1,000.
Can you set it up where you don't have to do the automatic sweep?
Yes. Yep.
So you can control when you take money out of the investments
Absolutely.
and not get swept automatically down when the market's down $800?
Yes. Yep. So you would just set your threshold really high then. So, you know, you'd have to have $20,000 in your account or whatever it is, because you want to be able to control where those sweeps go. So to set up your investment account, you go to Manage Investments, and then you can update your sweeps if you want to set those automatic sweeps. And this is where you would do it. Again, we have a $1,000 minimum. You can set that at any dollar amount that you choose. And then again, it will tell you the performance of those funds. These are the funds that we have to choose from. And this is what I was talking about regarding the expense ratio. If you look at some of these, they're all very, very small. So you can compare that to other investments. If you have a financial advisor, you could take this list to them if you need help selecting which funds you want to invest in. So we've got a full diversification of funds. If you're not sure, we do have some of the life strategy funds that will say, I'm going to retire in 2025. I'm going to, you know, it's already diversified based on your age or your retirement age. There's also, we do offer, again, this is just another view of your investment performance. One thing I do want to note on here, the P on there is the prospectus. It will give you all of the research information on that fund. So if you want to do some research on it, we make it very easy. We have that full prospectus out there that you can see performance over the years. You can see all of the prospectus information, all of the research that's available. So there is a tool that will walk you through, very similar to maybe what you've seen for your retirement plan, where it will ask you what your risk tolerance is, when you plan on retiring, maybe what you're estimating some of your expenses to be, and it will actually pick the funds that it recommends for you. You can click accept, and it will put your investments into those funds, or you can say, no, I want to pick on my own. So, but it will give you a suggestion for how to invest your HSA dollars. Again, it will just ask you a series of questions. This calculator is also great if you plan on, if you set a contribution level, it will tell you how much would be deducted from your paycheck. It will also help you calculate if you're trying to save a certain dollar amount. It's just a tool. So the mobile app, again, is probably my favorite tool that we have. You can go out to the Google Play Store. You can go out to the iTunes app and download those. There's no cost. You just search for HSA Plus, and you can download the app. And again, same username and password, or you can do the Touch ID to log in. There's also a scanner on the mobile app. So if you're not sure if toothbrushes are eligible or not, you can scan it and it will say, yes, it's eligible, or it's eligible with the doctor's prescription, or no, it does not qualify. One thing I'll caution you with the scanner though, and again, this kind of goes back to the technology being ahead of, a little bit ahead of itself here. If you were to scan the Band-Aid brand, Band-Aid, it would say, yes, it's eligible. If you do the generic version, If they've registered it as Band-Aids, as that type of qualified expense, it would show up, but otherwise it may say no. If you're not sure, I would always scan the brand name. You can purchase the generic one, but if you're not sure, I would scan the brand name, because most of the Kimberly-Clarks and Procter & Gamble's have all registered those barcodes as qualified medical expenses. Some of the generic ones are not. So as you can imagine, there are millions of barcodes out there. It's not up to us to register them. It's up to the manufacturer. And so some of them do a much better job than others. But I would scan the brand name, and you can always purchase the generic. Debit card, we talked about, so there's a $3,500 limit if you're paying a hospital or clinic. If it's over that, you could do it in 2 transactions, but that's a daily limit. And we had to set limits somewhere just from a fraud protection standpoint, so these are the limits that have been set. Again, you can order additional debit cards. Probably the biggest takeaway from today is save your receipts. I can't emphasize that enough. Again, the mobile app, you can take a picture on your phone. It's really easy to do. It will, if you go to do a distribution, it will ask you, do you want to upload a receipt? And it will automatically turn on your camera for you and take a picture of it. For security reasons, that is not saved on your phone. It's a cloud-based tool that we use to save the receipts. So if you're worried that if you lose your phone or you've got receipts, things and stored on there, it doesn't save it on your phone. It will send it automatically up to your HSA account where you can view it at any time. Yeah?
Can you go back and upload receipts to previous transactions?
Absolutely. Absolutely. And again, you can scan and do it online, or you can take a picture with your mobile app. Questions? And we're right about on time here, so yeah.
What is the process to transfer your HSA to different financial institutions?
Yeah, so most of them have a transfer form. So if you have an HSA somewhere else and you want to combine it with your associated one, out on the tools and the resources should be a transfer form. If not, you can check with HR. They'll have transfer forms for you. But you complete that, and they send the funds directly to wherever you're transferring the funds to. So you can have multiple HSAs. I don't know why you'd want to. It's kind of a nightmare to keep track of everything. But if you want to combine it in one, most of those providers will send you a transfer form.
But you could take one and divide it in 2 if you want.
Oh, sure. Yep. Yep. Yeah, you could have as many HSA accounts as you want. And if you've had previous employers, you still have an HSA wherever they had theirs, and you have your HSA here, you could. It just kind of becomes a little more from a management standpoint.
So after retirement, if we get a different insurance company, we can still keep this account?
Absolutely. Yep.
If my wife was the owner of the next account, could I roll this over into that? Or not?
Nope, because you can't have joint accounts. They're still separate. So,
This I would have to keep, and then it would be a separate one.
right, right. So your HSA dollars remain your HSA dollars until you spend it all, or it becomes part of your estate and goes to the beneficiary that you name. They're always your HSA dollars until you spend it. So it will last through retirement, and the figures I've seen lately for medical costs into retirement are staggering. So at some point you're probably going to spend it, but you don't have to spend it now. And again, if you have medical expenses, you can pay them out of pocket, save your receipt, and you can always reimburse yourself later. So it's a great savings tool, and especially with the investment options, long term, you get a better return through the investments than you would just from interest rates, though interest rates are starting to finally go up again. But it's a great savings tool. Yeah, any other questions? I know you've got another session to get to here. Does this help understand your online and HSA accounts? I know there are some handouts too. There's some frequently asked questions in there, kind of did you know things, and we've got additional resources online, and I know your HR department also has some videos and some other things, but we're always happy to help. Our customer care center is always available to you if you've got questions. So thank you very much. I appreciate it.